Is it possible to outperform the market with a simple trading strategy? In this video, we are going to try to find the answer to this question. However, we will not be using any trading software. Instead, we will analyze the historical data using tools like SQL, R, Excel, and Tableau.
Hi, my name is Joaquin, and this is my second case study. I've been trading since 2018, but I'm still inexperienced when it comes to languages like R and SQL. These are important skills that not only help you explore areas in ways that trading software sometimes can't, but they also allow you to analyze data in a more hands-on way, letting you get closer to it and discovering things that might otherwise be overlooked. That is why this time I wanted to challenge myself and perform the analysis using only these tools. If you'd like to follow along, there's a link in the description where you can find the code and the visualizations. Without further ado, let's dive into the strategy.
The strategy we will analyze is a mean reversion swing trading strategy in a daily time frame. We will focus only on long positions and not consider shorts. It took me less than 20 minutes to come up with this strategy because it is straightforward. I aim for simplicity because in trading, simpler approaches tend to be more effective. When there are too many moving parts, the likelihood of something going wrong increases, and obtaining an accurate backtest becomes challenging. And since we will conduct a manual analysis, it will be significantly less time consuming. Okay, this here is a daily chart. Each candle represents a day. The line we see here represents the 50-day simple moving average. The idea is that whenever the price falls below the 50 SMA, the value of the SMA becomes fixed, creating a reference line. These lines act as series that reset whenever the price falls below the 50 SMA. We identify them based on the price. That's also why prices during the analysis will have decimal numbers, because they serve as unique series, as identifiers. However, you don't need to worry about this for now, because we'll get back to it later. Next, we will measure the maximum positive and negative distances between the price and the frozen SMA line. Why do we measure the distance to the frozen line rather than the 50 SMA? It's because the moving average is always changing. It wouldn't make sense to say, I'm going to short when the price is 5% above the MA and exit when it's 5% below the MA, because in that case you would be entering and exiting at the same point, likely resulting in a breaking even. That's why you need a static reference point. Returning to the frozen line, we measure the distance and calculate average distances to gain a better idea of how prices behave. For the averages, we are taking into account the last 5 years. Why 5 years and not 1 or 10? Well, I think 1 might not be very accurate because you might have a super slow year followed by high volatility in the next year, making the distances from the previous year seem much smaller in comparison. So, in theory, the bigger the time period, the more market events and behaviors you cover. However, if you make it 10 years, for example, it won't adapt quickly to changing environments. So you'll need to find a balance. Although, to be fair, to pick the most optimal time frame, I should have conducted an analysis and made a data-driven decision. However, I didn't, so I'm basing the decision mostly on personal experience. Well, let's get back to the strategy. We have the trigger, the entry, and the exit. The trigger is the point it needs to reach in order for the trade to happen. In other words, if the price doesn't reach the trigger point, you can't enter the trade. The entry is the point where you enter the trade, and the exit is where you exit the trade for a profit. Now, let's say the average positive is 2% and the average negative is minus 6%. The trigger is going to be the enter point multiplied by 2. In this case, the enter point is the negative average distance and the exit point is the positive average distance. Then we also have the risk-reward ratio and the stop loss. The risk-reward ratio is the ratio you obtain by dividing the potential profit by the potential loss. The stop loss is the point where you plan to exit the trade if things don't go as expected. In this case, the stop loss is going to be defined by the risk-reward ratio. In other cases, it's better to do it the other way around, especially when doing discretionary trading. But at the end, it depends on the system, as each system is a separate word. We will assign the risk-reward ratio a value of 2, meaning if we win, we are going to make 2 times the amount we are risking. So if the distance between the entry and the exit is 8%, the stop loss would be 4% below the entry. So the line lies at minus 10%. Okay, let's walk through the steps now. The price is going up and suddenly, boom, it breaks the 50 SMA. Then it keeps going down and reaches the trigger point. If we recall, the trigger was double the amount of the enter. The enter was around the average negative, which was minus 6%, so the trigger was waiting at minus 12%. Once this condition is met, then we have to wait for the price to reach the enter price or the enter level one more time. When this happens, the system enters the trade, and then if the price goes to the stop, we lose the trade, and if it goes to the exit, then we win the trade. So that's it. Now, what's the purpose of using percentages to measure the distances instead of dollar amounts? The main reasons are first, price, or better said, dollar amounts are not a consistent measure over time. If we say we need to enter $4 away from the open, it's not the same when the stock is at $5 as when the stock is at $200. So if you're taking the past 10 years to make your backtest, this is going to be a problem. Second, price is not a consistent measure among different stocks. Different stocks have different prices. So if we want to make a system that fits the most amount of stocks, you'll have a similar problem. With that in mind, starting from a semi-fixed point, like the average negative or the average positive, seems like a good idea, because they are fixed enough to avoid some of the randomness of the market, but flexible enough to adapt to changing environments. If, for example, we do average negative multiplied by 2 for the enter, average positive divided by 3 for the exit, also modifying the trigger and the risk reward, we could fine-tune the system, and that lets us add flexibility to the setup. Because those numbers can be changed, they become variables. The idea is to always multiply the average negative, the average positive, and the enter to obtain the enter, the exit, and the trigger. The risk reward will stand alone. To simplify the system, we are going to be doing only multiplications. That's why, in this case, to obtain the enter, instead of dividing the average negative by 2, we are going to multiply it by 0.5. And with these variables together, we obtain combinations of variables, like for example 4 for the risk reward, 2 for the number the average negative is going to be multiplied by, 5 for the number the average positive is going to be multiplied by, and 3 for the number the enter is going to be multiplied by to determine the trigger point. And so on and on and on. The idea is to try all the different combinations of variables my CPU allows until we can obtain the most profitable combination among the stocks we try. Those stocks are going to be Apple, Microsoft, Johnson & Johnson, Walmart, Procter & Gamble, ExxonMobil, IBM, Chevron, Google, and Berkshire Hathaway. Later we'll see why and how we choose those particular ones. One more thing before I forget. We will also be using the 200-day simple moving average as a separate experiment. The condition works this way. Whenever the 50-day simple moving average is above the 200-day simple moving average, that means we are okay to proceed with the trade. If it turns out to be the other way around, then we will not be able to proceed with the trade. This is to try and see if going with the trending markets is beneficial or not for our strategy. And remember, we are going to be doing only longs.
I know some of you might be thinking, didn't you say this was going to be a simple strategy? The truth is that initially it was simpler, but it got more complex along the way. Although to be fair, I think that compared to others, it is still pretty simple because it relies only on one technical indicator. For the backtest, we are going to be testing the period from 2012 to 2023, which totals 11 years.
Now, why did I choose those stocks to perform the analysis? The idea is to avoid biases as much as possible. There is no point in conducting a backtest with the 10 largest stocks in the S&P today because if they are in the top 10, most likely it's due to a good performance over the last decade. So the results of the analysis wouldn't be fair. That's why I did things as if I were in the year 2012, and I did use the 10 largest stocks in the S&P 500, but as of September 2011. In the next part of the video, we are going to go through the whole coding process and then the visualizations and conclusions. I began by gathering the necessary data. To do that, I visited Yahoo Finance and downloaded the historical data of each stock from the beginning of 2005 to the end of 2023. Why 2005 if the backtest is going to start in 2012? Well, because we'll need 5 years prior to that to calculate the averages mentioned here, and 1 extra year that we'll need in order to calculate the 200 simple moving average. Then, using Excel, I added an ID column that numbered each row to ensure they wouldn't get mixed up during the analysis. Initially, I had planned to use the date column for this purpose, but it caused some issues. Therefore, I made the decision to create an ID column instead. Then, we continued the analysis using PostgreSQL in VS Code. Nearly the entire process we will be going through, both in SQL and R, is just for one stock. In this case, we will focus on Apple, and we will need to repeat the entire process for each stock we want to backtest. Okay, let's go with SQL now. First, I created the table. Then I imported the data frame, checked for duplicates in the ID column, and also checked for duplicates in the date column just in case. Next, I created the 200-day simple moving average column and calculated it. Bear in mind that since it takes 200 days to calculate the averages, as I just mentioned, the first 200 rows of the historical data won't provide any accurate averages. I repeated the same process for the 50-day simple moving average. Additionally, for the earlier mentioned experiment, I created the smash distance column. This column calculates the distance between the 50 SMA and the 200 SMA, allowing us to determine when the 50 SMA is above or below the 200 SMA. Another column I created is the low 50 distance column. This column contains the percentage distances between the low and the 50 SMA, which we observed earlier as a crucial part of the strategy. At this step, we checked for any duplicates. If duplicates exist, the frozen line won't be able to act as a unique series. Then I created the frozen SMA column. Here I took all the distances from the low 50 distance column, and whenever the distance is greater than 0, it displays the value of the 50 SMA, and when the distance is below 0, it displays 0. This column is going to be the reference line. Finally, I exported the data frame to continue the analysis in R Studio. Once in R, I created 3 main scripts. The first one is responsible for generating the results for each combination of variables, resulting in approximately 1,000 files for each stock, with 1 file for each possible combination. The second script is called the totals script, where I created a data frame that contains each combination in a row and shows the corresponding profit or loss for each combination. And the third script serves as a summary of the totals. Instead of analyzing a single stock, it combines data from all 10 stocks, allowing me to merge the data and calculate averages to determine the best combination overall. Now, we are gonna go through the first script, where I began by loading the packages needed for the analysis. First, I imported the data frame that comes from SQL. Next, I replaced the positive values in the smash distance column, which represents the distance between the 50s and the 200 SMA, with the word positive, and negative values with the word negative. This step is not essential but helps to tidy things up. Here I ordered the data frame. Steps 4, 5 and 6 are needed to extend the frozen SMA line from the moment the price breaks down the 50 SMA until it breaks it down again. To do this, I kept the price of the 50 SMA at the moment it was broken and copied that value in every row until the 50 SMA is broken again. In this step, I changed all values to the number 1, except for values with a 0 beneath. If you recall, the cells that have a value of 0 was because the distance between the low and the 50 SMA got negative. So the values that have a 0 beneath are the values of the 50 SMA right before price went below it. In step 5, I replaced the values of 0 and 1 with NA. In step 6, I replaced the cells with NA with the value of the cell above, filling the series and completing the reference line that will be used to calculate the averages. In the next step, I created the low frozen dist column, where I measured the percentage distance between the low of each candle and the frozen SMA line. Step 8 involves shifting the values of the frozen SMA column 1 row down. ensuring that the series always starts when the low is below the 50 SMA. This way, I can avoid having exit or stop signals before the enter signal appears. You will understand this later when we discuss the signals. In this step, I erased the value of the first 200 rows, which are the ones where the SMA was not fully calculated, just in case we need those rows for future analysis. Here, I created a new data frame named result neg, where I first calculated the minimum number in the low frozen disk column for each series of the frozen SMA column. This means calculating the maximum negative distance the price separates from the reference line. Then, for each series, I took the last 5 years of those maximum negative distances and calculated an average. Step 11 repeats the previous step but for the positive averages. In this step, I took the results from the steps 10 and 11 and added them to the main data frame. Step 12 is for the auto-numbering of the files that will be exported. The following part of the code is where the optimization happens. In step 14, as the comment says, I assign the values that will be used together with the average negative and the average positive to set the entry, exit, stop, and trigger levels. These numbers are the variables mentioned here and that will end up being these combinations. Step 15 is where the magic happens. Here, different triggers are set if different conditions are met. Based on those triggers, a category is assigned, which can be exit, stop, enter, or nothing. For example, in the case of the trigger, if the low frozen disk, the distance between the low and the reference line, is less than or equal to the trigger level we are looking for, then 1 is added to the cell. Similarly, for the trigger enter, if the trigger price reached the trigger level we were looking for and the price reached the enter level we were looking for, 1 is added to the cell. In the category section, if the trigger enter cell is greater than 0, it is assigned the enter status. We also want to ensure that the exit and stop conditions were not met before the enter conditions. Otherwise, we might get a false exit or stop signal. At the end of the step 15, I created a column that measures the distance between the enter and the stop, which will be essential later when selecting the most suitable combinations. Step 16 is where the data frame with the results is created. This data frame will be used for the rest of the analysis. Instead of having a row for each day, we have a row for each series of the frozen SMA, which is the reference line. The columns represent the number of enters, nothings, exits, and stops that appear for each series. In this step, if a column doesn't exist because the conditions for that category never happened, it is created to avoid messing with the rest of the analysis. Here I ordered the columns. Step 19 is where I added important columns to the results data frame. These include the date, the average value used for calculating the levels, and the variables used, which will act also as identifiers, because without knowing which variables were used, the analysis has no sense. I also included a column indicating whether the 50 SMA was over or under the 200 SMA at the start of each series. And lastly, a column that shows the average distance between the enter and the stop. In this step, I combined the variables to create the mentioned identifiers. Here, I kept only the rows where the enter condition occurred. I am not interested in series where nothing happened. Steps 22, 23, and 24 are for cleaning up and ordering the rows before exporting. Step 25 is where I exported the data frame with the results, generating around 1,000 files for each stock, which represents different possible combinations of variables. Okay, let's dive into the second script. The steps 1 to 4 were responsible for grabbing the files from the folder and iterating over each one of them. In the fifth step, I filtered to keep only the rows since the start of 2012. In the sixth step, I performed the calculations. For this, I set a risk of 1, representing 1%. With a risk defined, I calculated the loss, and the profit was the risk-reward chosen multiplied by the risk. If the chosen risk-reward was 20, then the profit was 20%. In the next part, I set a series of conditions to determine if each row was a winner or a loser. For example, if the stop had a value greater than 0 in a row, it was considered a loss. If the exit had a value greater than 0, it was considered a win. Additionally, I added a condition to check if the smashed disk column was positive or negative. If it was positive, it counted as a trade. In the seventh step, I added those results to a list. Then I combined them into a single data frame along with a column containing the name of the files from which the results were obtained. Using only the file name as an ID wasn't reliable because different stocks had different number of files. Additionally, it was impractical to check the combinations used, because that meant I had to enter each file separately. Therefore, I used the combination as an ID, solving both problems at once. This step was to avoid printing the whole path into the file name column. In the 10th step, I calculated the totals for each combination based on the winners and losers determined in the 6th step. The total P&L column contained the regular total, and the total P&L smash column contained the totals only for trades with the 50-day simple moving average above the 200-day SMA. I also created a column that contained the number of trades for a particular combination by counting the number of rows. Additionally, I calculated the number of days each trade took by summing the enters. Other columns included the average difference between the enters and stops, the number of winners, the number of losers, the win rate, the lose rate, the profit factor, the different variables used, the average negative and the average positive values, and the ID, which was the combination of variables. In the 11th step, I created what would be the file with the totals that I'll end up exporting, and I assigned to some columns the type of value they should have. In this step, I added the data frame from the 10th step to the recently created data frame, rearranged the rows, and finally exported the files. Lastly, in the third script, the one with the summary of totals, I started by importing the totals for each stock. In the second step, I joined the different data frames, keeping only the IDs, the total profit and loss, the difference between the enter and the stop, the duration of the trades, the number of trades, and the profit factor. In the third step, I averaged all the columns that had the same name to obtain a summary of the performance for each combination. Then I rearranged the rows and finally exported the file. Now, let's delve into the part we've been waiting for, the results obtained from the data. In this section, we will be viewing several Tableau charts. We will begin with the average maximum distances. In this chart, level 0 represents the starting point of each series where the 50-day SMA is located, the reference line. For instance, we can observe that for Apple, the average negative distance was approximately minus 5%, while the average positive distance was around 8%. Apple also exhibited the widest range, whereas Berkshire had the narrowest range. The overall weighted average range was calculated to be 4.44% and minus 4.2%. Here we can see the average price of the stock. This could be useful for calculating how commissions could affect the strategy. The third chart shows the most profitable combinations of variables overall. These results were obtained from the third R script, where we gathered all the totals and calculated an average. Remember that the first number represents the risk used. The second number is the multiplier for the average negative to get the entry. The third number is the multiplier for the average positive to get the exit. And the fourth number is the multiplier for the entry to get the trigger level. Here we can observe that the most profitable combination was the 20, 0.25, 0.25, 2, which yielded a non-compound return of 271% on average between the stocks from 2012 to 2023. However, is this combination useful? Probably not. If we hover over the bar, we can see that the average distance between the entry and the stop was 0.11%. In the previous chart, we saw that the average price of the stock was around $100. So a distance of 11 cents from the entry to the stop might be a little bit too tight for a swing trade. Although further analysis including volatility and slippage should be considered in the future to determine an optimal distance based on data, for now we will rely on experience. And I believe we need at least a distance of 0.3% to be able to trade. Now, if we move to the right side of the chart and set the minimum entry-stop difference to 0.3%, we can see that the most profitable combination is the 20, 0.25, 1.5, 2. For this combination, the average distance between the entry and the stop was 0.39%, the gain was 123%, the average profit factor was 13.4, the average duration of the trades was 6.37 working days, and the average number of trades per stock during the entire period was 42.3, which is around 4 trades per year for each stock. We will continue analyzing this combination, but first, let's see what happened with our experiment. In this visualization, we can compare the return of the regular strategy against the strategy where the 50-day moving average had to be above the 200-day moving average for the trade to be in play. As we can observe, the regular method was the clear winner, at least in terms of returns. Here we have the non-compound adjust for inflation return that each stock had with the 20R combination. We can see that Berkshire was the most profitable, while Chevron was the least profitable. Notice that none of the stocks ended up losing money with this combination. In the next chart, we can see the same non-compound adjust for inflation return that each stock had with the 20R combination, compared with the growth of the underlying assets and the growth of the S&P during the same period. All values are adjusted for inflation. These are the averages, one for the 10 underlying stocks together, and the other one for the stocks with the 20R combination. From this visualization, one could assume that simply leaving the money invested in the S&P or in the underlying assets would have been a better idea than actively trading. However, that assumption is not entirely true, because with the strategy, you could compound what you risk with every trade. Additionally, if you recall, the average duration of the trades in this strategy was about 6 days. This means that your capital is locked for periods of 6 days, not for a whole decade, as it would be if you invested the money. It also means that you could be trading several stocks at the same time. We will explore how that looks, but first, let's delve into the details of these 20R combination averages. In the following set of visualizations, we can observe the behavior of the 20, 0.25, 1.52 combination for each stock. For example, let's take Apple. The total number of trades for the whole period was 39, of which there were 6 winners and 12 losers. The remaining 21 trades didn't hit the stop or the exit before the series finished and the new series started. And most likely, the majority of those remaining trades were on the winning side, as the winning side was 20 times larger than the losing one. Therefore, the returns shown in the third chart fell short of the actual returns. Also, now that we are on this topic, one thing that I didn't mention before, but some of you may have noticed, is that the stop losses are accurate, but not the exits. That's because I used the law of the candles to calculate the levels for entering, exiting, or stopping the trade. In initial trials, I used the close of the candle to calculate these levels. However, it brought inaccurate results because, for example, if a stop loss was set at -6% and a candle reached that level but closed above it, the stop signal wouldn't appear, as if the trade wasn't lost. To address this issue, I choose to use the law of the candles instead. If the price at some point reached that -6%, then the stop signal would appear. However, the problem now was the exit, as it would always fall short of the actual exit. For instance, if the exit was at 10% and the stock went up to 12%, but the low of the candle never reached that 10%, it would be as if the trade was never exited. One possible solution would be to use the high of the candle for the exit. But this could lead to mixed results because a candle could hit both the stop with its low and the exit with its high at the same day. And since these are daily candles, we wouldn't know which level was hit first. So I had to make a choice regarding which one to sacrifice, the stop or the exit. It seemed logical to sacrifice the exit because if I choose the other way around and I had a profitable strategy, I wouldn't know for sure if the strategy was truly profitable, as the winning trades could potentially be losing trades. By doing it the way I did, although the actual profitability would always fall short, at least I knew that the winners are really winners and that the losers are really losers. Now, going back to the chart, in the last bar we can observe that the average duration of the trades was 6 working days. In this visualization, also for the 20R combination, we can see the profit factor for each stock as well as the average entry stop difference for each stock. Here we can see the win rate that the 20R combination had for each stock. And this is what happens when you compound your trades and trade several stocks together. In this chart, we can see the equity curve obtained from trading Apple, Johnson & Johnson, Walmart, and Exxon together. 4 stocks randomly picked from the batch we had. We compare this with what you would have gotten if you invested in the S&P during the same period. The strategy yielded 5.4 million, while the S&P resulted in 275k. To achieve the compounding effect, I simulated a starting capital of 100k and risked 1% for each trade. If two trades overlapped, I kept the one with the earlier entry. That meant there had to be a minimum of 7 trading days between one entry and the other. If that didn't happen, then I couldn't enter the second trade. Also, if you observe, this strategy applied to these stocks meant an average of 11 trades per year. That's around 77 days a year, which is obtained by multiplying 11 by 7 days, with your capital locked in a position. So there is room to add more stocks to the portfolio. However, I wouldn't get overly excited because we have to remember that this is a backtest where we pick the most optimal combination. It is very unlikely that if you start trading this combination today, you would end up with a result like this 11 years from now. With that said, I think it's better to have a good backtest than a bad one. So we can agree that it's a good starting point. Now let's see what would happen if we penalize the strategy a little bit more and instead of using 0.3% average distance between the entry and the stop, we use combinations that have an average of 1%. If we go back to the third visualization and change the minimum entry and stop distance, here on the right, we can see that for a 1% distance, the best option is the 10-0.25-22 combination, which has an average duration of 8.76 trading days for each trade. So, what would happen if we trade the same stocks we just did, but with this combination instead of the 20R1? And here we have the result. We can see that although it is a very profitable strategy that gave us a profit of 475k, compared to the 20R combination, it falls significantly short. To be honest, it is not far away from the S&P either, so in this case I think investing in the S&P would have been the best option. But here we had an average of 10.3 trades per year, with an average duration of 8.76 days for each trade. That means 90 trading days with the money locked. So again, we have room to add more stocks. Let's see what would happen if we add 4 more stocks to the mix, and also what would happen if we were very bad stock pickers and picked 8 stocks that had a very bad performance the last decade. And we'll compare that with the best 8 stocks we already have in our portfolio. Here we can see the return of the underlying assets of the 8 best stocks we have in our portfolio compared to the return of the 8 very poorly performing stocks we purposely picked. We also included the S&P performance as a reference. The 8 best stocks we have were Apple, Berkshire, Google, Johnson & Johnson, Microsoft, Walmart, Chevron, and Procter & Gamble. And the 8 worst stocks were General Electric, First Energy, Halliburton, Kellogg, Verizon, Occidental Petroleum, BorgWarner, and IBM. IBM was in the original portfolio, but I included it here because it had the worst performance. Remember, we are talking about the underlying assets here. Now let's see how they behave when traded with the 10R strategy applied. Okay, so the good news is that if you picked 8 very poorly performing stocks and use this 10R combination, which has a very generous distance between the entry and the stop, you wouldn't have lost any money, even when accounting for inflation, which was around 27% for those 11 years. Meaning you would end up with a net profit of around 92k. Of course, you would have had a better return investing in the S&P, and a much better return if you had picked 8 good stocks instead. So, in conclusion, to get the most out of the strategy we analyzed today, you should aim for the biggest risk-reward possible while keeping a realistic distance between the entry and the stop, and you should trade the most number of stocks possible. In order to do so, it might be a good idea to have a portfolio of stocks from different sectors so that opportunities won't cancel each other. Now, for the last chart, I wanted to check if there was indeed a correlation between the performance of the underlying assets and the performance of the stocks with the 10R strategy applied. To my surprise, there was little to no correlation, although I have to admit that 16 stocks are not a statistically significant number. But suppose it was, and this correlation ends up being true. That means you wouldn't have to worry that much about picking the stocks that will have a good performance over the years. It also leaves the open question of what you should be worrying about. Meaning, what would make a particular stock have a better or worse run with this strategy? Maybe stocks that go sideways are better than trading stocks, or maybe stocks that have more volatility are better than stocks with less volatility. Who knows? Further analysis should be made to clear these and many other doubts. Speaking of that, I wouldn't recommend to start trading this strategy based only on this analysis, because although it was long, it was pretty basic. I would make a backtest with a trading software, also do walk-forward testing with slippage and commissions included. I give more attention to the drawdowns, do Monte Carlo simulations, and consider other data like Bantharb's, SQN, and Sortino ratios. And if everything looks fine, I would paper trade it for some time to make sure it's really tradable. Then, with the green lights, I'll put a small amount of money to the test, and then a little bit more, and so on.
Well, it was a long ride, but we come to the end. It was the first video I ever made about trading, so thanks for taking the time to watch it. And I hope it was as useful to you as the whole process was to me. If you happen to spot any mistakes, I'll be grateful if you point them out. Once again, thanks for watching, and I hope you have a great day. Thanks, bye.